Hey everyone, and welcome back to the Deep Dive. We are going to be diving into the world of dividend stocks for 2025 using an awesome new report from buystocks.ai. Let's get into some of these companies. The first one on the list
Let's do it.
is Broadcom, ticker symbol AVGO. This is a semiconductor and infrastructure software solutions provider. And they've seen a really impressive 81.5% dividend growth over the past 5 years.
And with a current dividend yield of 1.2% and a projected payout growth of 11% in 2025, Broadcom seems very well positioned to continue rewarding investors.
So what are some of the factors that are really contributing to Broadcom's strong dividend performance?
Well, Broadcom's leadership in AI and network connectivity solutions plays a crucial role. There are high-growth areas, and Broadcom's strong market position generates substantial cash flow, which allows them to comfortably support and increase their dividend.
Got it. Makes
Yeah.
sense. All right, let's move on to the next one,
Okay.
which is another company with a really dominant market position that I think a lot of people have heard of. And that's Visa, ticker symbol V.
Visa is a true giant in the global payments market.
Mm.
They benefit immensely from the ongoing shift towards cashless transactions and their aggressive stock buybacks.
Right.
And steady dividend hikes make them very attractive to dividend growth investors.
Yeah, their current dividend yield is a little bit lower at 0.8%,
It-
but with a projected payout growth of 13% in 2025.
Now let's switch gears a bit and look at a company with a truly impressive track record of dividend increases, and that is Johnson & Johnson.
The dividend king, J&J, 62 years
Yes.
of consecutive dividend increases.
Diversified healthcare portfolio spanning pharmaceuticals, medical devices, and consumer health products, combined with their AAA credit rating, makes them a safe haven for investors seeking that consistent and reliable income.
And they have a pretty enticing dividend yield as well at 3.4%.
Now let's turn our attention back over to the tech sector
Okay.
and examine Microsoft.
Another big name. So Microsoft's been on a roll lately with 22 years of straight dividend increases.
Yeah, and fueled by their strategic investments in AI and cloud computing.
Mm-hmm.
And what's truly impressive is that they've achieved this growth while maintaining a low payout ratio,
Okay.
currently at 31%. This suggests they have ample room to continue increasing their dividend in the future.
So their current dividend yield is 0.8%. But it sounds like there's a lot of potential for growth there.
Exactly. Now let's delve into the energy sector.
Right.
Starting with Energy Transfer, ticker symbol ET. Energy Transfer stands out with its extensive pipeline network,
Okay.
making them a reliable income producer in the energy space.
Got it.
And their strong cash flow and low payout ratio allow them to comfortably support a high dividend yield
Okay.
of 6.5% and project distribution growth of 3 to 5% annually.
It's important to remember, though, that the energy sector can be volatile.
While Energy Transfer's current performance is strong,
Yeah.
investors should be aware of the inherent risks associated with investing in energy,
Huh.
such as fluctuating commodity prices and regulatory changes.
For sure. Okay, well, let's look at another energy player then.
Okay.
Kinder Morgan, ticker symbol KMI.
Kinder Morgan is a leader in natural gas transportation, and they're strategically positioned to benefit from the rising demand for LNG and the increasing use of AI in the energy industry.
So with a robust balance sheet, expanding infrastructure projects, a 4% dividend yield, and 7 consecutive years of dividend increases, it seems like they're in a good spot.
Their track record of consistent dividend growth is particularly noteworthy, considering the inherent volatility of the energy sector. This suggests a strong management team and a commitment to rewarding shareholders.
All right, let's look at this next one, which is a tech giant that just recently entered the dividend-paying arena, and that is Meta Platforms.
Formerly known as Facebook, initiated a dividend in 2024,
Hmm.
while their current yield is just 0.5%. Their substantial free cash flow and investments in AI suggest significant potential for future dividend growth. Now let's take a look at a company that offers a high dividend yield. Ars Capital,
Okay.
ticker symbol ARCC.
RSCs.
Ars Capital is a business development company, or BDC, providing steady dividends backed by robust earnings.
Okay, so what's a BDC?
Well, their focus on private middle market companies
Okay.
and their strong risk management practices contribute to their impressive 8.7% dividend yield.
Wow, that's a really high yield.
It is.
So what should investors keep in mind when they're considering a BDC like Ars Capital?
Well, while BDCs can offer attractive yields, it's essential to understand the nature of their investments.
Okay.
They typically invest in private companies, which can carry higher risks than publicly traded companies.
Hmm.
Thorough due diligence and a careful assessment of their portfolio are essential.
Got it. All right, let's move on to the healthcare sector and examine Novo Nordisk,
Okay.
ticker symbol NVO.
Novo Nordisk is a dominant player in the diabetes and obesity drug market. Thanks to blockbuster products like Ozempic, this market leadership, coupled with their strong financial position,
Yeah.
makes them well suited for consistent dividend growth.
Their current dividend yield is 1.7%, and they're projecting a pretty impressive 16% annual earnings growth.
That's a compelling combination. It suggests that Novo Nordisk has the potential to deliver both dividend income and capital appreciation,
Okay.
making them a solid choice for investors seeking exposure to the healthcare sector.
All right, and then finally we have the monthly dividend company Realty Income.
Yes. Ticker symbol O. Realty income is a favorite among income-focused investors seeking stability and predictable payouts. Their diversified real estate portfolio
Yeah.
and reliable monthly dividends have earned them a loyal following.
Yeah, they have an attractive dividend yield at 6.03%, and their track record of 26 years of consistent dividend growth is really impressive.
It is indeed. Realty Income's consistent performance and long history of dividend growth make them a compelling option for investors seeking a steady and predictable stream of income.
Okay, so we've just gone over a lot of different companies, but what should investors really be looking for when they're evaluating all these different options?
It's not just about chasing high yields.
Right.
It's about understanding the underlying factors that contribute to a company's ability to sustain and grow its dividend over time. Consistent dividend increases are a strong signal of a company's financial health. It indicates that they're generating sufficient profits to not only maintain their current dividend payout,
Right.
but also increase it year after year.
So the next criterion is payout ratios. So can you explain why that's so important for dividend investors to pay attention to?
Certainly. So a payout ratio is the percentage of a company's earnings that it pays out as dividends.
Okay.
A lower payout ratio,
Yeah.
ideally below 80%,
Okay.
suggests that the company has ample room to reinvest profits back into the business.
So they're not giving out all of their profits as dividends.
Exactly. They need some to keep growing the business.
All right, so the third criterion that's highlighted in the report is
Yeah.
earnings growth.
Yes.
So why is that so important for dividend investors?
Well, a company's ability to increase its dividend over the long term is fundamentally tied to its ability to grow its earnings.
Hmm.
If earnings are stagnant or declining,
Yeah.
it becomes much harder to justify raising the dividend.
Finally, they emphasize the importance of industry position.
Yes,
Can you talk a little bit about why that's important when choosing a dividend stock?
of course. So companies operating in stable or growing industries tend to be less susceptible to economic downturns or industry-specific challenges.
Yeah.
This stability allows them to generate more consistent profits, which translates into a higher likelihood of sustained dividend growth.
So you're not just looking at a company in isolation.
Right.
You're looking at the whole industry that it's a part of.
The BuyStocks.ai report offers some really valuable tips on portfolio allocation to help you along the way.
Okay, awesome. So what's the first tip?
Well, the first tip is diversifying across sectors.
Okay.
Yeah.
And why is that so important?
Well, diversification is a fundamental principle of investing.
Mhm.
By spreading your investments across different sectors like technology, healthcare, energy, and real estate, you reduce the risk of any single sector's performance negatively impacting your overall portfolio.
So if one sector is doing badly,
Right.
hopefully some of the others are doing well
Exactly.
to balance it out. So the second tip they mentioned is exploring dividend reinvestment plans,
Yes.
or DDRIPs.
D-raise?
So can you explain how those work and why they can be beneficial?
Sure. DRPs are fantastic tools for long-term wealth building.
Okay.
They allow you to automatically reinvest your dividends back into the same stock.
So instead of getting a cash payout,
Yes.
you just use that to buy more of the stock.
Exactly. You are purchasing more shares with each dividend payment.
Got it.
It's a powerful way to harness the power of compounding, allowing your investment to grow exponentially over time.
Makes sense. And then the final tip that they mention is finding a balance between high-yield stocks and dividend growth stocks.
Yeah, and this tip emphasizes the importance of aligning your investment strategy with your financial goals.
Okay.
If you're primarily seeking current income, high-yield stocks might be more appealing.
Okay.
However, if you're aiming for long-term growth, dividend growth stocks, even those with lower initial yields could be a better fit.
Because they'll probably grow more over time.
Exactly. It's about finding the right balance for your individual needs and investment horizon.
Okay.
If you're younger and have a longer time horizon,
Yeah.
you might prioritize dividend growth.
Makes sense.
If you're closer to retirement and seeking current income, high-yield stocks might be more suitable.
Well, thank you so much for joining us on this deep dive into the best dividend stocks for 2025.